Tesla is absolutely on fire in the past year or two. Recently, they announced another stock split to their stock so it's more affordable to the general public. Following the news, Tesla shares jumped higher the next day, and you might conclude that stock splits can push up stock prices or increase the value of a shareholder's investment in a company. But is it really the case? If so, why won't other companies do the same? In today's video, I'm going to give you some background information on the subject so you can understand what's happening here. So sit back and relax while I break down what a stock split is and how it might affect you. It's more compelling than you think. To better illustrate the concept of stock split, let's begin with the true story. A friend of mine was on his way to get some pizza for dinner. While he was picking up his order, the cashier asked him if he liked it in 4 or 8 pieces. In which my friend replied, "I'm trying to watch my weight, so I'm gonna eat less. Please cut it into 4 pieces. But in fact, my friend ate the same amount of pizza that night, no matter how many pizzas the pizza was cut into. The story pretty much illustrates how splitting stocks work. In this story, the pizza represents the market value of the company. The number of slices is like the number of tradable shares, and the size of each slice is the stock price. If we cut the pizza into more pieces, even if one slice appears smaller, the whole pizza itself still stands at the same size. So when we buy a stock, we're essentially buying the whole pizza being the company's market cap. And only if a company's market cap increases, the pizza will then become larger, meaning that the stocks we hold will increase in its value. So if we look at the situation from the beginning of the video again, looking at the stock price to judge whether to buy a stock is equivalent to looking at the size of each slice of pizza and ignoring the overall size of the pizza. This means just focusing on a company's stock price doesn't reflect whether a company is a good purchase. Whether a company is a good purchase depends on its intrinsic value and its market cap. If you are a value investor like Warren Buffett, you would only want to purchase shares of a company when its intrinsic value is lower than its market value. We'll talk more about it in a future video. If by now you're not quite following, let's take a look at another example. Suppose that you have 1,000 Apple shares at $100 per share. This is worth $100,000 in total. You assume that the company will split its share at a ratio of 2 to 1. This means that your shares will change from 1,000 to 2,000. Each share is worth $50 instead of $100, and your total value still stands at $100,000. In other words, stock split itself will not affect the value of the stocks you hold. Of course, not all stock splits are necessarily 2 to 1. It could be any ratio. For example, sometimes shares will be split 3 to 1, 4 to 1, 7 to 1, or even 3 to 2. So if it's a 3 to 2 split, your 300 shares will turn into 450 shares after the split. But regardless of what the ratio is, the value of your stocks will remain the same after the split. But hold on, if a stock split doesn't affect a company's market value, why would companies want to split their shares then? Well, splits can come with its own set of benefits too. The first benefit of a stock split is to satisfy investors' psychological preference for a lower price. More people will be willing to buy into a stock if they see that the price have become cheaper. For example, if a company's stock price was around $100 before, but it has risen to $500 now, those of us who didn't hop on the train when it was at $100 will think that it's not worth it to buy in at $500. However, what if the stock price suddenly changes back to $100? Now, the psychological pressure will be much less, and more people will be willing to buy in. The newly invested funds will push the stock price to naturally rise again. This is the main reason why many companies choose to split their shares. Everyone has the same buyer psychology because we have been trained to react to price drops by countless advertisements we see every day. For example, if I ask you how much a bag of chips costs, you might know the answer right away. But if I ask you how much does the bag of chips weigh, not a lot of people will be able to answer. We tend to be very sensitive to the price of a product, but we rarely think about its value. Let's take Apple as an example again. The company now ranks first in market value and is known for using stock split to attract investor funds. In 2020, Apple split its stock for the 5th time since its IPO, a 1-to-4 ratio. The company said the split was to make the company's shares more accessible to a wider range of investors. Well, indeed, before the split, the price of an Apple share was close to $500, but after the split, its shares dropped to $125, which is almost equivalent to a pair of AirPods. So if you're optimistic about Apple's stance in the industry, would you rather buy a pair of AirPods or a share in the company? most investors will choose the shares because it's a good deal to exchange the money of a pair of headphones for future profits. And as we mentioned before, this is Apple's fifth stock split. Since its IPO, Apple has split its stock in 1987, 2000, 2005, 2014, and 2020. In 2014, Apple split its stock 1-7, and the price dropped from $650 to below $100. And by keeping its stock price around 100 all year round, Apple has the ability to attract more shareholders to buy into their stocks. And this is not a tactic used just by Apple. Many companies, especially the fast-growing ones like Tesla, in August 2020, its market value was around $280 billion, and its stock price was at $2,200 per share. This turned many retail investors away from buying Tesla, even if they wanted to. So as a result, Tesla announced a stock split of 5-1. After the split, the price of a share went from $2,213 to $440. And sure enough, after the split, it attracted a new wave of investors, which ushered in its price to surge from $440 to $880. And Tesla's market value reached $500 billion. And while all of this was happening, Tesla's fundamentals didn't change much at all. And this is exactly what they wanted. Now Tesla wants to perform a stock split again for the same reasons. Another advantage to stock split is that it can increase the liquidity of an underlying stock. The more liquid of the stock, the easier it is to make daily trade operations. This comes in handy in situations like, for example, when you want to do dollar cost averaging every month. And since it's a monthly commitment, the amount of investment wouldn't be too much, maybe a couple of hundreds of dollars per se. But when a single share of Amazon would cost more than $3,000, so in this case, we would have to pass up on the opportunity to invest in Amazon as the money won't work out. On the other hand, if Amazon performed a stock split and became just around $100, then more people would be able to invest in Amazon and take advantage of the fast growth of the company. In another situation, many investors like to allocate stocks they buy by proportion. For example, some people will buy 60% tech stocks, 30% blue chip, and 10% in bonds. However, if the company's stock price is too high and the investor don't have enough funds, it may not be possible to reach the desired shareholding ratio. But regardless, invest a fixed amount every month like dollar cost averaging into a low-cost index fund is a great financial habit to have. We'll make a future video on this, so stay tuned. There's no such thing as a free lunch, and stock splits also come with its set of drawbacks. That is, a stock split may increase a stock's volatility. For this reason, not all companies like to split shares. The most notable example is Warren Buffett's company Berkshire Hathaway. Warren Buffett is well known for advocating long-term investments, so he wants to attract like-minded long-term investors and not short-term speculators. Therefore, the 91-year-old investor has never allowed his company to split its shares. As a result, at the time of writing, Warren Buffett's Class A shares have a staggering $520,000 price tag, which is really expensive. And with that high of a price tag, I'm sure you will think through the decision from top to bottom. And after careful consideration, it's easier for you to become a long-term investor rather than hold it for a short term. So there you have it. Hopefully you have learned something about stock splits. So next time you see another announcement of a company's stock split, be careful with what that might mean to your investments. If you like today's video, be sure to subscribe to our channel. This is Money Therapy, a channel about money. See you in the next one.